Hello, welcome to the Markets Policy Macrocast. I'm John Fagan, joined as always by my partner Brendan Walsh. And it is inflation week. It has been highly anticipated, and coming into the consumer price index and the producer price index, aka sort of the wholesale or factory gate inflation data this week. And yeah, markets ended up getting whipsawed. What happened, Brendan?
Yeah, so the consumer price index came in much hotter than expected. A lot of that was driven by the cost of car insurance, and fixing your car is really high, and I think that's a real measurement. But also the shelter costs, so the housing costs have continued to remain elevated, despite the real-time data showing that it's fallen off fairly precipitously over the last 6 to 9 months. That more has to do with the methodology of the BLS, and it kind of works with a lag. And then the next day we got the producer price index, which that's just the inputs that, if you're making something, it goes into that. And that came in much lower. Traditionally, the producer price index leads the consumer index by 3 to 4 months. So there is theoretically some deflationary forces down in the pipeline, with the housing components, which should, over the course of the year, start to fall, which is in the CPI, most importantly, is 40% of the component. But also interesting, the PPI feeds into what is the Fed's preferred price measurement, which is the PCE price index. So they take a lot from the CPI, but they also take a decent amount from the PPI. And there's a way to compute it and things like that. And everyone's already done their math. So the March PPI, PCE price index should come in well below what the CPI showed. It should probably be like a 0.2 month over month, where the CPI was a 0.4. So this puts the Fed in a bit of a sticky situation, where the CPI is remaining much more elevated than their projections were, which has caused the market to massively, price out what they had expected. And I think the market had gotten way over their skis and had priced in 8, cuts in the next 12 months. Now, what is it? Maybe just one cut is expected.
It's sort of a coin flip right now. Fed fund futures are now a coin flip between 75 is still in the picture, but it's more like 50 is the expectation. It looks like the base case is that the Fed is gonna start in July or later in the year, and that is
where Powell had hoped to start in June.
Right. And so now it's backed up, and so it's a 50-50 odds for the start in July. The full rate cut isn't priced in until November. And that's fully priced in, right? The full odds. And so it's still between 2 and 3. And as we remember, of course, the interest rate projections that came out at the last meeting were still for 3, but the commentary from Fed talking heads since then has really been on the cautious side. So clearly the tail is fattening toward later and less easing, and the markets are struggling to digest that. But as you say, it's a nuanced picture here, and there are lots of head fakes when the data is this noisy.
So 2 things really interest me that it's going to be very difficult to the Fed. If, they do kind of throw in the towel and say, okay, our projections weren't quite right. Inflation is stickier than we thought. But then the shelter component starts to fall off a cliff, and it really, showed that they kind of were right. They were just a little early. How do they handle that messaging? But 2, and this is much more important for today, is the strength of the dollar is causing some, chaos in other countries' currencies. And how much does the Fed, factor that in? The Japanese yen is probably a perfect example, but especially in emerging markets. That's something you focused much more on in our previous career. What do you think about that?
Yeah, I think that the classic sort of formulation is the dollar's our currency, but it's your problem. When we're looking out at other countries, right? And I don't think the Fed right now, the symptoms of like, strong dollar dynamics, sort of the classic almost go back to the 90s, right? Those like dollar crises in LATAM and Asia and so forth. That has obviously been part of the analysis on the policy side for a long time, but it really doesn't play and feature as prominently in situations like this for the Fed because the dollar is strong, but it's not trending in a the rate of change right now is
Yeah.
not all that
And we're
witheringly
still below
strong.
where it was, 6 months ago.
Right, yeah. And you can look at, particular currencies like the yen, which are, at 35-year lows and struggling. But you look at the euro and it's kind of,
Yeah.
it's not particularly weak against the dollar, neither is the pound. And you can go across the board. Emerging markets, we've seen emerging markets trade in very differentiated ways. And so that I think is that allows the Fed to put considerations of dollar strength on the way down in their list of priorities in terms of policymaking. And of course, and now they're still in inflation fighting mode, so a strong dollar is actually rowing in the same direction as their policy.
Yeah.
So overall, that is, I think something that the Fed will always have in mind and in their in their panoply of analysis, but won't be anywhere near a controlling decision. I mean, it seems as though the Fed has kept a pretty steady line. So it sounds like you would advocate that the Fed not overreact to the CPI, hold the line, say, we're still liking what we're seeing, but we need, the early indications that they're going to stick with this mantra of, we need a little bit more data. Things are
Yep.
still on track. And, if, as you predict, the next couple of months, that statistical lag dynamic of the owner's equivalent rent slash housing component in CPI begins to reflect the more real-time declines in rental prices, then they will be their confidence in a continued downtrend in inflation will be borne out. So sounds like
Yeah.
stay the course is the message for the Fed.
But the other thing that's somewhat working against them is, the Chicago Fed, New York Fed, Bloomberg, they all have their financial tightness measurements. And financial conditions aren't overly tight other than really the housing market. The 7% mortgage rate seems to be something that the borrower, doesn't want to, is going to wait out. But the rest of the economy is kind of doing pretty fine with rates where they are. So I suppose they have both that. Is inflation too sticky? And then on the flip side, do we actually need more rate cuts? Do we need to lower rates? And where actually is this neutral rate that we never can quite figure out what it is?
Yeah, right. I mean, it's always a finger in the wind. What is that neutral rate? Chair Powell has characterized current interest rate settings as restrictive, quite restrictive, and so obviously he's conveying the sort of consensus thinking that the neutral rate is far below where we are right now.
Yeah, exactly.
But
Yeah.
yeah, but as you say, right, if that's really true, if interest rates are really restrictive, typically you don't see stock markets around all-time highs when you
Yeah.
have, persistently restrictive financial conditions. And but
Plus
we've
2% GDP growth,
right, yeah,
and
and the consumers
an
chugging
employment
along.
market that is still, producing 200,000 to 300,000 jobs a month. Yeah.
Yeah, and we'll get retail sales next week, and industrial production. We saw PMIs look, pretty good. Not
Yeah.
great, but again, no smoking gun by any stretch of the imagination. And so if you're looking for the impact of higher interest rates, as you said, look no further than commercial real estate and other certain pockets of the economy, which led us to I think it was a couple of months ago publish a piece called "Head in the Oven, Feet in the Freezer," and it really is that extremely differentiated impact of interest rates across this very nuanced economy. And you
Totally.
look at the leadership of the stock market, the Magnificent Seven. I mean, the AI story seems to be almost
Yeah.
immune to high interest rates. Now, that's easy to say right now. We've seen some of these high flying stocks begin to, you know, begin to
Yeah,
tire out a
Nvidia
little
is
bit,
taking a
take a
breather.
pause. What's
But
that?
now Nvidia has taken a breather in the last couple of weeks, and it's down 10%, but it's down 10% from being up like 700%. So you
Right.
got to keep things in perspective.
And we're also going into earnings season. Now, last earnings season, we got the fourth quarter, and for a lot of the mega banks kicked off last quarter's earnings season with kind of a mixed bag. It was okay, but not great. And a lot of the other industries were kind of the same story. You got hits and misses, but then you get into the Magnificent Seven, sort of the heart of the order, so to speak, of earnings season, and most of them really knocked it out of the park. And so, if we have a similar
Exactly.
dynamic, even if the Magnificent Seven, let's leave Tesla aside for now.
Yeah, that's its own
But
story. Yeah.
yeah, you look at the others
And what
performance.
actually is Tesla? It's a little bit more than a car company.
Yeah, it's a topic for another podcast. But yeah, you look at the other ones, and you say to yourself, look, if they start putting up, continue to put up these gaudy numbers and have a real, fantastic endogenous growth story around the AI innovations that just seem to be moving so quickly, and the monetization of it is impressive. Well, do you really want to bet against the stock market going into earnings season? Based on what
Yeah.
we saw
And today we got
last quarter.
JP Morgan, which is the biggest bank in America, and their earnings were quite good, above expectations. But more importantly, they didn't call out any yellow light warnings on the consumer. That's doing quite fine. The one that their CEO and chairman Jamie Dimon called out was inflation as potential issue, and then geopolitical. But most
Right.
importantly, those are two things that a bank doesn't have any control over more than you and I. The things that they do, make loans and collect those loans, that part of the business is doing great.
Right. And if you're looking at the bank earnings from a macro perspective, Wells Fargo came out this morning, and they're obviously very retail exposed,
Yep.
right? Very housing market exposed. And their numbers looked really good. And their stock is up, and they've been performing, quite well in this environment. Now, obviously, there's the concern is, similar. It's similar to what you said about CPI, which is, it may be riding high now, but it can come off very precipitously. And there's, kind of the negative story that has persisted in the background. The skeptics of the U.S. Sort of economic stability have really said, the U.S. consumers wily coyote, right? They've run off the cliff. They're spending way beyond their means. They have just not looked down yet, right? They haven't gotten that realization moment that they're way, way exposed, and they've built up credit card debt, and eventually they're going to have to sit on their wallets and retrench their spending in meaningful ways. It's going to feed through, and there is the JP Morgan said the economy is slowing, and you're seeing it in the credit numbers. That's what they're saying. Obviously, it's not precipitous by any stretch of the imagination, but that's always the downside case is the consumer is eventually going to run out of
Yeah.
momentum, and then fall to earth.
But on the flip side, everyone has a job. So if you have a job, you get paid and you can adjust your spending. It's not that necessarily you have to immediately default. That's what you do when you lose your job. So we are in that situation where I think the consumer is a little bit above their skis, but you can pull back, and maybe we're in 1% GDP growth, but not that we have to fall off the cliff and go into a huge recession.
Yeah, and just going back to what you said, I mean, citing JP Morgan CEO Jamie Dimon, the flagging inflation and geopolitics, those are obviously very intertwined, and we're seeing oil prices going up
Exactly.
again today. So U.S. benchmark WTI is not, last time I checked, at its 2024 high. It's not at these eye-watering over 100 levels, but 86 is expensive, and 87 is knocking on the door of 87, which was essentially the 2024 high so far. Again, we've seen a lot higher than that, but gasoline price, it's just persistently high. And seasonally, looking at the way that gasoline prices have stayed elevated even through the off season, getting into the summer driving season, the summer gasoline prices are going to be a political issue too, and they're very and it certainly looks as though the kind of pressures that we're seeing in the Middle East and fattening that geopolitical risk premium in oil, those don't seem to be abating anytime soon. They seem to be getting worse. Obviously, with the news coming out that Israel. The U.S. Officials are warning that Iran is going to directly attack Israel over the coming days, potentially. That is not a good sign, clearly, and oil prices and gold, for that matter,
Yeah,
are
and all
are
commodities.
expressing
Yeah,
those concerns.
yeah,
So it's a very fluid picture in financial markets in response to that, because that those higher oil prices, gasoline prices, energy prices, and the supply chain issues that we talked about in our previous Macrocast episode with Skyline Policy Risk Group President Lawrence Smith, those have the potential to keep prices on the higher side, elevated, supported, however you want to say it. So it's a challenging time for the Fed. It looks like the Fed, we hope the Fed stays the line here. Going into earnings season should give equity markets a little bit more wind in the sails here after they've taken a breather. And and Treasury, but watch Treasury markets. They'll be very sensitive to the Fed, and we think that Fed commentary that remains balanced and doesn't overreact to the CPI is going to restrain Treasury yields from going too much higher here, and that will set the table for a relatively placid second quarter. That's our baseline expectation for now, but watch this space. So thank you for joining and watching, listening to the MPP Macrocast. We'll be back next week, and thank you for listening.